Joining us now is Jefferies chief market strategist David Zervos. I don't know, some kind of hawkish commentary from Bowman overnight. Saw consumer inflation expectations rise in the University of Michigan numbers this morning. You sure they're going to pause in June?
I think so, Sarah. I mean, they've done a lot, but you're right. That 5-year ahead inflation expectation in the University of Michigan at 3.2 is going to raise some eyebrows. Last time it got to 3.3, that's when they moved us from 50 to 75 at that June meeting last year. So over the weekend, just before the Fed meeting then. But, we're still within the range. I think a lot of things are going their way. We've got short-term inflation expectations through break-evens back down to 2. We've got the long-end break-evens, very steady. We've got the dollar reasonably strong and strengthening. It's interesting to see the dollar back below 109 against the euro when everybody's super bearish the dollar.
Yeah.
That's certainly hurting some people. So I think the Fed's in a very comfortable place. And a lot of the people that have been hating on the Fed and really bashing Jay for the last year and a half are looking like they might have to swallow some humble pie. I mean, we've got a 3.4% unemployment rate and inflation's back below 5%.
Right. That's soft landing-ish, David, though I guess the question is if that's already factored in, now at what point does the equity market have to worry about recession if we do start to see worse data and more credit tightening, which is expected?
Exactly, Sarah. I mean, that's what the Fed is trying to do, slow things down. They want to bring aggregate demand down. They want to get inflation back to 2. They want to keep inflation expectations anchored. All that's part of the process, and it's the tough love that we've been administered, and I think we have to accept it. And there's going to certainly be some folks who get hurt along the way. Some good businesses with bad capital structures are going to go away, and some bad businesses with bad capital structures are going to go away. It's really about capital structure now, and that's why we've focused at Jefferies all year on really thinking about that part of the capital structure that we want to be in, and we think the equity part is the most risky part. That's the part that's most vulnerable as the Fed's tightening and fighting inflation. So we're in the less risky part of the capital structure for the U.S. economy, which is high-yield bonds, senior secured high-yield bonds and loans.
Hey, David, did claims this week suggest that the labor market is really beginning to crack? Is UBS right that we get a negative print probably in Q3?
It's certainly possible, Carl. I don't think we should rule out a couple of quarters of negative real growth. We had that actually in the first 2 quarters of last year, and it didn't really feel all that bad. So I think you've got to expect that growth is going to slow. Some companies are going to get hurt. People are going to downsize. Some folks are going to get fired. The unemployment rate should rise. It hasn't. It should, but it might not. I mean, we've got a lot of other dynamics in there that are making it pretty sticky to the downside. But I just don't see the cataclysmic story that a lot of other folks are spinning. Or, Carl, the other story that really was, very common last year, which is the Fed's going to lose control of everything. We're going back to the 70s. Inflation is rampant. Jay Powell is the reincarnation of Arthur Burns. If anything, Jay Powell is the reincarnation of Paul Volcker. And let's hope he doesn't have to hit us as hard as Paul Volcker did. I don't think he will. But I think if he has to, he's going to hit us hard. And that's why I leave open the option that there may be a little bit more toward the end of the year that they do have to do. But I think they really want to pause for a few meetings and watch how things pan out. They've done a lot of heavy lifting already, and they've got inflation and unemployment really on trajectories that I think they're quite comfortable with.
Hey, David, I mean, high-yield bonds don't always do particularly well in a recession, particularly if there's a deep one, which clearly you don't expect.
That's true, David. I mean, you have to worry a little bit about it. But again, equities would do worse, right? I mean, if you're in the senior secured part of the capital structure, the equity kind of has to get wiped out before you get touched. So you'd much rather be there than in the equity market. So I think for us, it's a way to tiptoe back into the risk trade after last year being out of the risk trade and really kind of being unhappy with the idea that you want to sort of jump in to a Fed that's going to jump into a market where the Fed is going to have to be aggressive on you and sort of stand back a little bit. That was our theme all of last year. Fed puts gone, stay away. But, this year you can tiptoe back in, and our way of tiptoeing back in is really to look at either the high yield bond, the high yield loan, or the structured credit markets, all of which, really offer you a lot of protection, David. I mean, we're looking at yields 9, 10, 11%. These are typically yields that you've only been able to get in times of really serious dislocation and crisis. So you've got an enormous amount of protection in those bonds.